Hi, I'm Darcy Crow, Senior Investment Advisor and Portfolio Manager at Canaccord Genuity Wealth Management. Thank you for taking the time to listen today. We wanted to talk about the upcoming U.S. election and what we've seen historically in election years. So we're getting a lot of questions from clients and investors concerned about what might take place over the weeks ahead given the uncertainty leading into this election. So what we've done is we've looked at a lot of historical information, what we've seen going through, over the last 50, 60, 70 years through these election years and what the market has shown us throughout history. So Fidelity actually put through some really great slides. So we're going to walk through those slides and show you historically what this has meant for markets. So I'm just going to go ahead and share my screen with you right now. So what this first chart is showing you that in election year, the equity market has generated on average a 6.3% price return. So that's in line with year one and year two. We do typically see year three being a very, very strong year. The reason why that might be that very often the president in place at the time is sort of preparing for the election year ahead. But however, we do see that year four is not abnormally, down or off. It is in line with year one and year two of the presidential cycle. We do see, however, that the returns are typically occurring in the second half of the year, both in non-presidential election years as well as presidential election years. That second half of the year is typically very strong. However, it is significantly weaker performance in years in which the incumbent has lost. So you'll see in the chart below, the light blue line is years in which the incumbent party won. However, the dark blue line shows the second half of the year when incumbent party has lost. What we do see, though, is that the weaker equity performance is probably reflecting a softer economy because recessions have historically led to incumbents losing. So is that performance actually due to the fact that the incumbent has lost or that the economy has actually been weak going into the election? And that's what this chart shows us here. In every single instant where there was no recession 2 years before the re-election, 100% of the time, that president was re-elected. However, if you look on the other side, where a recession 2 years before re-election was seen, except in one case, those presidents were not re-elected. So that goes to show us it has always been a very, very high prediction if the economy is doing well, 2 years out before re-election, in all cases, the president has been re-elected. So given this, and given the state of the economy currently, it is not surprising that Biden currently has a lead over Trump in the polls. Currently, even a full Democratic sweep appears to be possible, as Democrats only need a net gain of 4 Senate seats for a majority. So I want to take a moment here to talk about this chart. Regardless of the election outcome, there's various economic policy effects that are offsetting, which in our belief is that there'll be a minimal overall market impact. So when you look at taxes, that's been one of the biggest things being talked about is that if Biden does win, is there going to be a very negative tax outcome and therefore negative effect on the markets? Well, of course, Trump is regarded as a more positive there. However, you look at Trump trade policy, that's somewhere Trump is looked at much more negatively, whereas Biden would have a significantly more positive outlook there. Fiscal stimulus is another area where Biden is certainly looked at more positively, whereas regulation is somewhere where Trump is tilted towards. And lastly, the unknown, which is incredibly important in our recovery, is virus management. And, that's to be seen in the months ahead as we come out of this and as we recover. But virus management will be incredibly important as well. We also wanted to take a look at equity market performance in years in which taxes have been raised. And what we saw is that there is no significant difference when we look throughout history in terms of performance of equity markets in years where taxes were raised versus where taxes were not raised. There's actually, and when we looked at EPS for companies within the S&P 500, again, no significance in terms of the growth within EPS that's been realized in those years versus other years as well. So what that means is what is critically important is where we are in the business cycle and where the economy is. So we believe we're at the early cycle phase at the moment. Activity is rebounding, GDP is rebound, credit is growing, profits are growing, policy is incredibly stimulative at the moment. What's incredibly important right now is the recovery as we get through and virus management, as we talked about. But we're sitting at a point right now where policy is incredibly stimulative. We're sitting at record low interest rates and a huge amount of liquidity within the market. So what does that mean in terms of where to be positioning and how asset classes have performed at this phase? And what we see here is that early in the cycle is incredibly bullish for US stocks, less so for investment grade bonds as well as cash. If you look at obviously later in the cycle, those are much more even in recession periods, much more negative for US stocks and significantly more positive for investment grade bonds. But as we work through this recovery phase and we're looking at a very stimulative period, recovery period, growth in the market, in the past historically that has proven to be very, very positive for US stocks. So thank you for taking the time to listen in today. Absolutely, there's going to be volatility in the weeks ahead as we come up to the election, as well as there's a lot of fear in the market right now that we're not going to know the results of the election coming out of it, which is very possible. We've seen that happen before. So there will be volatility, but at the end of the day, history shows us what happens in the equity market is much more determined by EPS growth, economic growth, rather than the actual election and the headlines itself. So we believe that the markets will continue to be driven by those key factors rather than the election itself, despite some volatility in the short term. Thank you so much for listening in, and we look forward to, if there's any questions at all, we'd certainly be happy to answer them, and we look forward to speaking soon. Thank you.